a second, because starting in the early 70s, we had an oil petrodollar.
Sure.
And isn't that right now part of this unwinding in the macro sense? And we should point out that you're a macro analyst. You've got the book Currency War, which is a macro look at things that are going on. Your background, you help unwind long-term capital management here in Connecticut. You're very keen on these macro issues. But today, with what's happening politically in America, some are positing that it's a breakdown of that petrodollar because it ties in Saudi Arabia, seems to be matched up against Putin over Syria for rights to build a new pipeline from Saudi Arabia to Europe to compete with Putin's pipeline from Russia to Europe, which is, okay, I don't want to go on a huge tangent politically, but what happened to the petrodollar is my question.
Well, of course, the gold standard was banned in 1971. In the late 70s, kind of from 71 through 79, he really had a period of chaos. You know, people, they didn't know, should we have fixed rates, floating rates, go back to gold, abandon gold, etc. And, the U.S. was actively disparaging gold, dumping gold at the time, and assisting on a dollar standard. So the Arabs were very worried. So Kissinger cut this deal, you're right, said, look, you guys agreed to sell us oil for dollars, and we'll maintain the value of the dollar. That was backed up by Volcker and Reagan and carried all the way through Republican and Democratic administrations, not just by Volcker and Reagan, but also by Bush, James Baker, Bob Rubin, Bill Clinton.
And Volcker backed that up by raising interest rates.
He said, we're going to make the dollar valuable again. It was the king dollar period, the sound dollar period. So, okay, not a gold standard, but a dollar standard. And that actually worked fairly well from 1980 to 2010. The problem is in 2010, Obama, Geithner, and Bernanke tore up the dollar standard. Said, we're going to cheapen the dollar. We want to import inflation. We're going to cut interest rates. You guys are on your own. So now there is no standard at all. So you have a new period of chaos. But if you're the Arabs, the deal has been torn up. They say, we're not going to maintain the value of the dollar. So the Arabs are like, well, okay, what do we get for our oil? Just paper money that you say you're trying to cheapen. So now they're exploring a lot of alternatives. The GCC may have a common currency. Europe is creating a ruble zone.
So the GCC being the cooperation
in
the
the Persian Gulf. That's exactly right. You're seeing the emergence of regional reserve currencies. Korea, Japan, and China, despite all the tensions around the islands and all that, the fact is their trilateral trade is exploding, and they're starting to accept each other's currency. So, and then of course you have the BRICS, led by Putin most recently, and they're going their own way. So what you're seeing is this slow diminution in the role of the dollar. It's not overnight, it's not immediate, but it's kind of like U.S. foreign policy. If the U.S. doesn't care, if the U.S. isn't in charge, nobody's in charge. We see that playing out in Syria. Same thing with the dollar. If the dollar is not the global reserve currency, then it's jump ball. You don't know what you're going to get. Return to a gold standard is a possibility, but I don't see that in the immediate future. I think we have to have a collapse first, a collapse of the dollar standard in the petrodollar deal. Then it'll have to be replaced with something. Now, that'll either be the SDR, which is the IMF world money, the special drawing right, or gold, or some combination of the two. That remains to be seen, but the dollar standard is definitely collapsing. It's been abandoned by the United States. It's not that we're under attack. We're abandoning it ourselves.
Okay, so the 2008-2009 collapse period, we're about 5 years going into that, post that period, and we've been saying on the show that, and really looking at a lot of your work, is a lot of the conditions that led up to the collapse are still there, but have gotten much worse because the leverage has gotten a lot worse.
Right.
So now we're set up for another collapse, and coming out of that collapse, you're saying there will be some other reserve currency status, could be the special drawing right, the SDR, or looking at gold again, or some combination of the two. So the question is this collapse, A, baked into the cake? In other words, it's going to happen with a high degree of certainty, and B, will it be, in fact, a magnitude larger than what we saw in 2008?
Yes, both of those things are correct. The collapse is definitely coming because there were no structural reforms, no changes. So in 2008, we heard about too big to fail. Well, guess what? The 5 biggest banks in 2008 are bigger today. They have a higher concentration of all bank assets. The derivatives books are larger. The leverage is larger. We have new bubbles coming up in student loans. We don't have subprime mortgages anymore, but take a look at the student loan market, over $1 trillion. That's another accident waiting to happen. So all the conditions are there. But here's the difference, Max. When this happens, not only will it be bigger, it will be bigger than the Fed. The last time the Fed bailed it out, the Fed has taken the balance sheet from $800 billion to over $3.2 trillion in the last 4 years. We haven't had a crisis since 2009. There's no shortage of liquidity. Yet they've taken their balance sheet to over $3 trillion without a liquidity crisis. What are you going to do if we have a liquidity crisis, which I expect? They can't take it to 6 trillion or 9 trillion. They're at the limit. The Fed is technically insolvent on a market basis. They don't have that capacity. So the only clean balance sheet left in the world is the IMF. So when this crisis happens, the only way you're going to be able to reliquify the world is by printing SDRs.
Wait a minute. You said there was no liquidity crisis going back 5 years. There was a liquidity crisis,
yes.
But they met the liquidity crisis by expanding their balance sheet. What you're saying is that, unlike that period, this next wave will overwhelm any capacity for the Fed to expand to what would need to be 30 trillion potentially in bad debt. So it's like the Hurricane Sandy crisis where the entire lower Manhattan was completely underwater and the lights went out. And am I correct?
Yeah, so I separate QE1 from QE2 and QE3. QE1 was a legitimate role of a central bank. When there's a liquidity crisis, you're supposed to provide liquidity, going back to Badgett, in his description of what a central bank does in the 19th century. And the Fed didn't do it the right way, but they were right to provide liquidity. But once QE1 was over, beginning with QE2, that was not about liquidity anymore. That was about propping up nominal GDP because velocity was imploding. That's really micromanaging the economy. That's not the Fed's job. So QE2 and QE3 were completely wasteful. We will look back and see it as the greatest failed experiment, in history. But the problem is they did it anyway. So now with the balance sheet of 3.2 trillion, if you have a liquidity crisis, what are they going to do? As I say, go to 6 trillion. There is a limit. Actually, I've spoken to President Evans, the Chicago Fed, and President Lockhart, the Atlanta Fed. They said that there is no theoretical limit to the Fed's balance sheet. Maybe legally, but I think that's wrong. I think there's a political limit, there's a practical limit, and when you have a liquidity crisis, the Bank of England is no better, Bank of Japan is no better. You look around the world, People's Bank of China has printed more money than the Fed. And so the only place you're going to get new money printing is from the IMF.
Right, let's talk about that limit for a second, because the place where that might show up is in the bond market.
Sure.
So the 10-year bond market, which is the linchpin of the global banking system, global economy, all credit reverse to the 10-year bond market, it, about 6 months ago or so, seemingly hit a low on yields. So in other words, a high on the bonds themselves. In the United States, it was at a 240-year high, and in England, it was at a 300-year high. So some are saying that the rise in yields telegraphs economic growth. But that seems odd given that there's a huge people on food stamps and hourly wages are down and the job picture is a bunch of part-time jobs. Doesn't seem like growth to me. So is that rising bond yield, A, is it telegraphing what you're saying, that there's nowhere to hide and they're heading toward another crisis? And B, is it a secular move? In other words, is this like going to be a 10 to 15-year bear market as you do see these larger cycles in markets?
Well, it's a very good question, Max, but you have to remember the Fed is manipulating everything. So it's hard to look at history and know exactly how it's going to play out. The thing is, there is such a thing as a bull steepener, like an expanding economy with expanding credit, more demand for loans. Interest rates should go up. That's a normal cyclical expansion. That's not what we're saying. This is much more of a bear steepener. It's because, frankly, China and Japan are buying fewer U.S. government securities, and the Fed may taper, and that will tend to increase interest rates. Now, I spent a lot of time saying what the Fed wants. But just because you want something doesn't mean you get it. This is part of the Fed's impotence and the impotence of policy. What the Fed wants is either extremely low real rates or even negative real rates. They want a situation where inflation is higher than the 10-year note. So just put the 10-year note at, say, 3%. You got to get to 4% inflation or 3.5% inflation to have negative real rates. What's been happening is the opposite. Nominal rates are going up, inflation is going down, so real rates are getting higher, and this kills the economy. So, we'll see what happens with the Fed tapering. My view all along is that they won't taper, but it's a really close call.
But let me jump in. We only have about 30 seconds left. Isn't there a huge problem, I guess you could call it the transfer mechanism, between what's happening at the central bank level and that money getting into the real economy? Because it's being aborted by the banks to get in the middle, who are using it to lend back to the Fed or to speculate or to buy assets. And again, this predatory banking class is becoming highly disruptive, right?
Sure. This is part of financial repression. Let's say you're a banker, okay? So you borrow at 25 basis points, you invest at 3%, you make 275 basis point yield, you leverage it 10 to 1, you got 27% returns on equity. It's free money. Why would you do that? It gives the Treasury a captive buyer. The banks are captive buyers of the Treasury.
Okay, we've got only 10 seconds left. We didn't get to gold exactly, but I take it you're still bullish on gold.
Absolutely. Long term, I've got it at $7,000 now. It's probably higher.
All right, fair enough. Jim Rickards, author of Currency Wars. Thanks so much for being on the Kaiser Report.
Thanks, Max.
And that's going to do it for this edition of the Kaiser Report with me, Max Kaiser, and Stacey Herbert. I want to thank our guest, author Jim Rickards. If you want to tweet us, do so.